man.
Welcome one, welcome all to DeFi Crypto and Airdrops, our DeFi High edition with David, and all of the content brought to you by David and DeFi University. So this is our new show where we introduce you all to entry-level DeFi. So DeFi University has great content from beginning to advanced, but we wanted to do a show where we could articulate an entry point to DeFi in the simplest way possible. So, David, what do you want to talk about today?
So, first thing, Myke, since I'm here in Florida, have you ever gone to a foreign country and you pay for things with dollars and everything is just much, much, much cheaper because you're paying with dollars? Dude, like moving from California to Florida, that's exactly how it is. Like when I was food shopping last night, I bought some ground beef. It's literally half the price, literally half. Like most of the things that I bought for food last night were at least 50% less. Many of them like closer to 60 or 70% less. So,
I'm sure because the state taxes, California, everything is so taxed.
Couldn't believe it. Okay, so what I want to talk about today, I took all of those courses that I created for DeFi University and I turned them into books. And I published the books on Amazon. And the thing that's been so funny is that people are buying the perpetual futures and liquidity provision book, but there's a reason why the courses are in order. You're supposed to get to that stuff last. You're supposed to start with the investor mindset stuff, because I think that it's mostly psychology. Like being able to be consistently profitable, I think is mostly down to this thing. Mostly down to your brain and how you react to risk.
Well, I think that's true of a lot of things in life. Your mindset and how you react and how you make your decisions on just daily life. In personal relationships, at work, and investing, and driving on the road. If somebody cuts you off, how do you what's your mindset and how do you react to things like that? It's going to have a huge impact on your life. So absolutely.
It really does. And so here's the question that I want to start with. And then what I want to do is I want to hop into a lesson and I want to apply one of these lessons from actually the investor mindset course. I want to apply that to a real trade that I entered last night. So why don't we start by taking a look at markets, and then let me just go ahead and share my screen here and let's just hop into it. So I've got my screen share popping up here. There we go. Okay, so the first thing that I want to do, Myke, is I just want to go ahead and run through what we might see in markets right now. And, recall yesterday, we were talking about this level as being in Bitcoin. So this is a Bitcoin, this is a daily chart here. And remember, we were talking about this level of support and we were saying, hey, if this breaks, then I think it's probably pretty likely that Bitcoin could come back down here to around 80. And test those lows around 80. So we're starting to see this support break, but it's not quite there yet. Very, very close. I mean, look, this could be, if you want to take a little bit more risk, this could be an interesting entry on the short side. Now, what I did last night is I got short ETH, but as you're going to see, Myke and everyone, in the lesson from the investor mindset course, I got short ETH, but I followed all of the steps in the lesson when it comes to risk management and position sizing. And the way that the lesson tells you to size your positions makes it so much easier to emotionally hold on to a position because you don't feel that pull. So, but if we just take a look here at Ethereum, again, this is that level of support that we were pointing out just yesterday. And and what were we talking about?
No, I remember that. We talked about it at great length. And you were, showed that trend line and you were telling people that, we're going to go down and we're going to touch that. And either we're going to bounce off of it and it's going to remain support, or it's going to dip below and potentially become resistance.
Exactly. And so now that we're at trend line support, where do we go from here? Well, this is Ethereum. And so if Ethereum is just now getting down to trend line support and Bitcoin looks like it could be about to break this level of support. Let me just go ahead and make sure that I'm drawing in this trend line properly. Now that we've taken a look, there we go. So I need to just edit this a little bit, and we're getting close to support for BTC. ETH is basically at support. So one thing that we can do to compare these two is we can price ETH in Bitcoin terms, and that will tell us which one is outperforming the other. So what I've got here, Myke, this is a chart of ETH BTC. So it's the ratio between Ethereum and Bitcoin. And the first thing that I want to do here is I want to start by zooming out. Now, this is a chart that Ben Cowan made pretty famous over the last couple of years because he was so good at calling this pair, ETH BTC. And this is really interesting to me. So this pattern here, it does look like a big long-term flag to me. That's what it looks like. It could be a little bit long in the tooth, though, to be a flag pattern. But notice here, we've got this level of resistance, and Ethereum.
That's like an insane trend line right there. Just how many times it's come up and tested that.
Oh, I know. I know. And, for me, I was always of the opinion that Ethereum would actually outperform Bitcoin this year. But I'm starting to question that. Now, here's this level of resistance, and this is a weekly. And up above, we've got the 200-week moving average. And so my thought here is, well, if Ethereum's going to outperform Bitcoin over the next 12 months, let's say, well, that could mean that ETH outperforms, but still declines in US dollar terms. So this chart could go up even as ETH and Bitcoin lose value against their US dollar pairs. So this is just the cross pair, ETH BTC. Now, what does it mean if this chart goes up? It means that Ethereum is outperforming Bitcoin. It doesn't mean that Ethereum is going up in US dollar terms, just that it's outperforming BTC.
So it might be that ETH isn't doing anything and Bitcoin's going down.
That too.
Okay.
That could happen too. Oh, yeah. And so when I just zoom in here a little bit, though, and remember, this is a weekly, this looks like a pretty big start of a breakdown.
Well, so we're really quick, because I think it's important that people understand charts like this, where it's, ETH BTC or ETH USDC or Arrow ETH or, something like that. This is what we're talking about in DeFi when you have a pair of assets and when you're in a pool. What David's talking about and the way that this chart moves up and down is basically how these two assets perform against each other. So if they're both going up and down together, they can be moving. And if they are moving perfectly together, it's not really going to move. But if ETH goes up and Bitcoin doesn't move, then you're going to see this chart go up. If you see ETH, dumping and Bitcoin staying stationary, then it's going to go down. And then vice versa. If Bitcoin either outperforms or underperforms, then it's going to move, different directions. So it's, this isn't a price chart for just ETH or just Bitcoin. This is a chart that is, and correct me if I don't use the right verbiage. But basically it's the way that the two assets move relative to each other. And this is what we talk about when we talk about correlation.
Exactly.
Correlated pairs. So sorry, go ahead.
Oh, no. This is great. So, that's the reason why I wanted to bring this up, because I'd like to use this chart of ETH BTC to find out if I'm correct in wanting to get short ETH, or maybe if I'm not. Because if I see ETH underperforming Bitcoin, and that's exactly what this chart is telling me, let me go ahead and zoom in from a weekly to a daily. And so on the daily, we can see this big level of resistance. That's that trend line that goes back a couple of years here. And there have been many, many tests of this trend line resistance. I kind of cut off the top here, but I could just draw it in like that. And so now you can see very clear level of resistance above. And down here, if I just go ahead and zoom in a little bit here and move this level of support right there to that level of support. So you see right here as price, this is not price, this is the ratio. As the ratio came down here to test near the 200-day moving average, that acted as a level of support for this ratio. But now look at what's happening. We're starting to lose the 200-day moving average. Now, why is the 200-day moving average so important? Well, I think it really comes down to people believe that it's important. And this level tends to get respected a lot, either as support or as resistance. And they say that nothing good ever happens below the 200-day moving average. So,
it's like midnight. It's like when you're in high school and your parents say you got to be home by midnight because nothing happens good after midnight.
Nothing good ever happens below the 200-day. And look at what ETH...
I'm actually earning 26% right now on my wrapped ETH, Coinbase wrapped Bitcoin liquidity pool.
So that's pretty great because of the correlation. You see, the thing with liquidity pools is if you're paired with a stable coin, you're going to generate a ton of divergence loss or impermanent loss. But if you pair with another volatile asset and they're tightly positively correlated, then you can really mitigate that impermanent loss because you don't have as much divergence between the two assets. Mm-hmm. They tend to move together a little bit. Yeah. So when I look at this, though, and I see ETH losing its 200-day moving average in Bitcoin terms, it makes me think that ETH could continue to underperform Bitcoin. So that means that, well, if we see more losses in the US dollar pair, I would expect ETH to accelerate to the downside and lose more in percentage terms than Bitcoin does. So how do I start to build a thesis for a trade? Because I can't just look at Bitcoin or look at a chart of ETH or look at a chart of the pair ETH BTC. That's not enough data. And I think it's really important now with all of the geopolitical events for us to at least take a look at the equity indices like the S&P and the NASDAQ and the Russell. I think these are important to track because, hey, you know what? When the orange wizard of tariffs decides that he wants to do something, that can really move markets. And, it's just kind of a cute thing to say to refer to Trump because, man, those tariffs, whenever he's thrown tariffs on, it's had some type of market moving impact. And so we've got to be able to track these indices. Now, what were we talking about yesterday with this move out of the S&P on the Sunday futures open? If I go ahead and zoom in here to an hourly, we will be able to see it a little bit more clearly. So remember that pattern that I was talking about? Here's the gap right here. And I was saying that, hey, you know what? If this gap doesn't fill over the next 48 hours, basically by tomorrow, by Wednesday, then we would have a gap and go. And that's what we're seeing so far. But it's not quite enough time to be able to say, hey, yeah, this is a gap and go. So what I'm looking for here is actually a bounce. That's what I'm looking for. I'm looking for a bounce and a gap fill. And so
that's what people are talking about when they talk about filling the CME gap.
Exactly.
Okay.
Exactly. So this right here, this is that CME gap.
So right those gaps kind of act like a magnet then.
They do. They really do. Yeah. And so, but if the gap doesn't fill, then this would start to look a little bit more bearish here for the S&P because we're basically sitting at an important level of resistance and very, very close to an all-time high. And we get the gap down on Sunday. If price were to continue to push to the downside, that's a gap and go. And I'm just thinking to myself, well, hey, maybe there's more room to the downside, but we've got to check in on volatility. So here's volatility futures. This is VX. Now, usually when people like to take a look at S&P 500 volatility, they will take a look at the VIX, VIX. So VIX is the calculation, VX is the tradable futures product. Now you can trade options on the VIX, but why is it so important to check in on the level of volatility? Because if you see volatility put in a high and start to retrace, now remember, volatility is a mean reverting asset class. And so if I zoom out here on this chart of VX, what you'll notice is that every time you get a pump, a real big push higher in volatility, it always mean reverts. Now, it might take a longer period of time or a shorter period of time to mean revert, but volatility is a mean reverting asset class. And so if we were to see a big move higher in volatility, that could actually mark the low for the equities indexes, like the S&P.
Hell. Thing has gaps all over the place.
It does. It does. So these are rolls.
Mind
the gap. Mind the gap.
Mind the gap.
So if you take a look at this, these are actually contract rolls. So these here, when you're trading the front month futures, people can also trade the back month or the back months. And so you can create what's referred to as, this it's basically a forward curve. So you've got all of these different expiration cycles for the volatility index futures. And you typically trade the front month because that's where the most volume usually is. But once you get closer to the next month, when you get close to a contract roll, as you can see here, they call them a switch, a contract switch in TradingView. I was always taught that they're referred to as a contract roll. But when you get close to that roll, if the back month is trading at a premium to the front month, that means that volatility in the future is trading at a premium to volatility in the present. And so if volatility is higher in the future than it is in the present, that's referred to as contango. Now, if volatility in the future is cheaper than it is in the present, that's referred to as backwardation. And so
all these crazy words, man.
I know, man. It's all the jargon. It really is. Contango and backwardation and contract rolls and you name it.
It's almost like we need to come up with a glossary, to share with the community or something like that, so that they can reference it.
Yeah, in fact, I have one.
Nice. There you go.
DeFi glossary.
There you go.
So why don't we do this, Myke? Now that we've just taken a look at a couple of charts, just real quick, this lesson.
Just so people know, this is the DeFi University that it links in the description. It's a free course. Everything on here is free. So don't worry about having to pay for it. We're not, trying to shill a product or anything like that. This is just good quality content. But that glossary, he had the alphabet, with it hyperlinked. You can, like, if you see us, or hear us, if you're watching, and he says something like contango, he clicks on that, and it will go to all this, the words that are used in DeFi that start with C. And you can go down to contango, and it will tell you what it is. So it's a great, I would bookmark this. It's a great tool to reference when you're listening to us or listening to other DeFi channels, that you can, help you understand, and it will help lock in what these different words mean.
And you know what's really cool about this too? You see in the search bar here, if you search for anything, what it's going to do is it's going to bring you to not just an answer, but it's going to point you to where that answer comes from in the course material. So it makes it really, really easy to find whatever you're looking for throughout these 5 courses here. So what I wanted to do here is hop into the investor mindset. And it's so funny because, Myke, the books on Amazon, people have been buying the Perpetual Futures book the most.
Yeah.
But the Perpetual Futures book, there's a reason why it's the last course, because you're supposed to get to it last. You should start with the mindset stuff, because this is the most difficult to master. And it probably takes the most time to master. And so I want to actually go through lesson 6, because this yesterday was extremely valuable, and I applied everything here from lesson 6, which is the psychology of risk management. I applied this here to a trade that I opened last night on ETH. And so I can show you that trade here. My take profit is very, very close to getting hit. And
let me guess, it's right on that trend line.
It is.
Surprise!
Right. It's very close. It's right. So my take profit is just at this trend line support. And so the way that I'm thinking about playing this is, okay, I caught this move. Great. Very, very close to my take profit level. But what happens if volatility over here, volatility futures, what happens if volatility has already put in a high for a little while? You know, what happens if the S&P actually comes back up and fills this gap? Well, I think that digital assets would
It's all about filling that gap, man.
Yeah, man, you got to fill that gap. I think digital assets would bounce. I think if volatility has put in a little bit of a high, maybe not for very long, this move in volatility up above 20, usually when you get up above 20, that's when you can really start to accelerate higher. But volatility it's not printed and held above 20. In fact, it's gotten rejected at 20. And so this is another level that we were drawing in yesterday. We were talking about this little double top up here that could form, and we had this 200-day moving average and that confluence there. And today, volatility popped and got rejected at the 200-day and at this level of horizontal resistance. So if volatility is getting rejected after pushing a little bit higher, as the S&P and the NASDAQ have pushed lower, if vol is starting to mean revert, that's an important term right there, mean revert. If that's what's happening.
What is mean?
So a mean is an average.
Okay.
And when you're taking a look at volatility, it usually has an average at some level. So it depends on the market regime. So if you remember, like during COVID, or even in 2022, 2023, if I zoom out here, volatility's mean back then was much higher. So much, much higher, well above 20 and most of the time into the 30s. So that is a much higher average level of volatility. So when you would see these big pumps, notice how it would mean revert, but it would mean revert down to 20. So the mean was closer to 20, a much, much higher level of volatility than what we see today, where the mean has been in the teens, like in the mid to low teens. Yeah. So when you have lower levels of volatility, the average move each day or the expected move up or down is much lower, right? Now, when volatility is much higher, like it was in 2022.
Is it true or not true? When the volatility is low, the market is much easier, or volumes are low, the market is much easier for market makers to manipulate.
Yeah, I don't know that I could say that it's easier for market makers to manipulate, but when volatility is much lower, you tend to see markets drift up. So there's always a little bit of an upward bias. Yeah, and when volatility comes down, when it gets too low, it can almost signal complacency in the market, in market participants. But what I've noticed is whenever volatility spikes, well, you definitely get much larger moves up or down. But when volatility is at a much lower average level, I think you tend to just get a melt up. So for me, when I'm taking a look at vol here, and I take a look at the S&P having pulled back a little bit, but I see that gap, I think that gap is going to fill. And I think that unless there's some big news event that, catalyzes further downside, unless there's something like that, I think traders and investors probably step in and buy even this little tiny baby dip. This is very, very small dip, but if the gap fills, I bet that ETH bounces at support. And I think so would Bitcoin. Now, what happens if the gap doesn't fill and volatility starts accelerating higher and the S&P pushes lower? Well, if that were to happen and we bring it back over here to Ethereum, I think Ethereum would probably break down below this level of support. And same thing for Bitcoin. And so if they don't hold support, where's the next level? Well, the first level to take a look at would come in on Ethereum right around like 2,800. For Bitcoin, the next level of support, if this current one doesn't hold, would come in right around 85. Now, if Bitcoin can't hold 85, I think it would go back down to 80. So that's just what I'm looking at a high level, technical analysis on markets, taking a look at the S&P, taking a look at Bitcoin, Ethereum, looking at volatility futures, and using those different assets together to form a market bias and, maybe build a little bit of a thesis and think about, okay, well, if I were to enter a trade, where do I enter? Where do I set my stop? Where do I set my take profit level? So by taking a look at a bunch of different assets together, you can start to put together a trade thesis. And one of the most important things, Myke, if I just bring it back on over here and we bring it to lesson 6, one of the most important things is after you've built that thesis, how do you size your position? Do you want to, the thing with position sizing is that it's really, really easy to trade much too big. And I think that that's something that most, if not all traders experience at some point, just trading too big,
or using too much leverage.
Or using too much leverage. Yeah. But on the opposite end, you can also trade too small. And so in this example that I'm just sharing with you here, I think that for me, this trade is, number one, quite a bit of leverage. I'm using 10x leverage, okay? This is the initial margin, or the collateral here, is less than 1% of the account that I'm trading out of. So, that 1% amount is really important. It allows me to be able to sleep at night, but the leverage that's a lot of leverage, man. 10x leverage. And I'm just thinking to myself,
those of you that might be new, the more leverage you use, so like 2x, 3x, 4x, what it's doing is, say that you put in $1,000. What it's doing is your trade pretends like if it's 2x, like it's $2,000, or if it's 10x, then it would be $10,000. So it's going to get you profits as if you're trading with $10,000 in this case, but there is a liquidation level. So the more leverage you use, then the closer the liquidation level is to your entry. So if it dips below that, you lose everything. So you need to understand using leverage, and not just in trading. There is leverage that you can take in, levering up your risk in, lending and borrowing strategies and, things like that as well. So make sure that you understand how the mechanics of these platforms work, before you just jump in and do these things. So sorry, go ahead.
100%. I mean, look, that is one of the most important things if you're going to learn how to trade and you want to trade futures. You've got to learn about leverage and funding rates. The funding rates are really, really important to understand too.
Explain funding rates really quick, because I'll be honest, I don't know a whole lot about it.
Sure. So funding rates are a really interesting mechanism for keeping the price of an asset on a perpetual futures decentralized exchange, keeping the price on that perpstex as close as possible to a spot price external to that perpstex. So
okay. So basically, it helps prevent potential arbitrage. So like differences in prices across different platforms and stuff like that. It tries to keep it all the same. Gotcha.
Exactly.
Okay. Keep going.
Yeah, and so the funding rate here, it will either incentivize traders to get long
Mhm.
or incentivize traders to get short. So this is a mechanism to keep the price on the perp stacks pegged as close as possible to the price external, a spot price somewhere else. So that's basically the function of a funding rate.
Mhm.
Now, when I'm taking a look at this position here, I really want to be able to talk through how we can size our positions so that we can, not have all this anxiety, not be just compulsively checking our phones, looking at quotes, not staying up nights, unable to sleep. All of these things that if you've traded at all, you've probably experienced. Well, I don't like any of that stuff. And let's just go ahead. I really want to hop into this. And I want to start here, Myke, by playing this video content. And I'm going to go through and play it and pause it along the way. And it'll give us a lot to talk about.
All right.
And all of this stuff is free. So anyone can hop in here and go through the lesson, go through the exercise, and learn about how to master risk and do so by making sure your positions are sized appropriately.
And
So
anybody that's just starting to watch, we had a bunch of people just join. The link for this 100% free course is in the description for DeFi University. So again, there's no catch, there's no, upsell, nothing like that. The only thing that David does that is paid is twice a day. He does 2 1-hour calls with him in the community, and it's $97 a month. If once you go through the course and you kind of have your questions and you want to kind of take it to the next level, that's the only thing that he charges for. So we're not shilling a product here. We're just trying to give you great content that David spent days making, weeks, months.
I spent hours, Myke. So many hours.
Literally hours. Well, I know that you leverage AI, which is just
I
smart,
do.
but it's really great content. And I just want people to understand that, if you go to this site, it's not going to tell you to pay or anything like that.
No, this is free.
100% free.
Yeah, so it's just, courses.defiuniversity.xyz. This is
It has
the course.
quizzes, it has,
Yeah.
checks on learning, all that stuff.
Yeah,
So,
it's pretty cool. Yeah. So it's actually a series of 5 courses.
Yeah.
And it's probably a good idea to go through them in order. And so that's why I actually want to start here with this specific lesson, just because it applies directly to the trade that I entered last night, which, it looks like it's about to hit the take profit, which is great. So let's hop in here. And I don't know, Myke, if you're going to be able to hear this audio when I hit play.
I'll give you a thumbs up.
Okay, so there could be some type of a setting that I need to hit in StreamYard. Let's see if it works. Yes? No? Okay, can't hear it. So let me go ahead and hop in here and let's see, what do I need to do to share sound over here in StreamYard? If I hit audio, I'm looking at audio here. I'm not quite sure that it will allow me to share my audio. Now,
Try
what do you think?
sharing the whole tab or something like that. Like whenever you did your screen share, and then there's
Okay.
a toggle to share audio as well, like when you first hit screen share.
Okay, got it. So if I share my entire screen, then I've got to share system audio. There we go. That should work now. Great. And just hit allow. Got it. Awesome. So this should now work. Let me know if this is working.
All right, welcome to the explainer.
Yeah? No?
Most
Maybe? Yes? Awesome. Great.
people think trading is all about picking winners. It's not. The real game is about how much you bet when you're right, and more importantly, how little you lose when you're wrong.
So really, Myke, the question that we need to answer as traders is, how much can I risk to find out if I'm right? That's really what it comes down to. And so figuring out what is the amount that you're willing to risk to find out if your trade thesis is correct, figuring out how much is that amount, that's what we're going to go ahead and dive into.
Today, we're going to decode the system that separates the pros from the gamblers, the psychology of position sizing. Let's just start with the most important concept right off the bat. The real battle you're fighting isn't against the market, it's the one happening inside your own head. This quote says it all, right? Your success isn't about some fancy spreadsheet. It's about whether you can manage your own mind when the pressure is on.
Emotions.
So this is just so important. It really, really is. And there's a reason why the investor mindset course is one of the first ones, because if you can't master yourself and master your emotions, good luck being a trader. It
Well,
will never
honestly,
work.
learning discipline over your emotions and investing is going to put you ahead of the majority of the people out there that you're trading against, because most people out there, especially these days, have almost zero discipline over their emotions. I mean, look at social media. It's perfect example. Somebody posts something, and all of the rage bait and stuff like that, and you just see the flood of people that have to comment on it. You need to be able to have that discipline. But yeah.
Yeah, man, you really, really do. I think that many traders, especially when they're just starting out, they'll see, number go up and they'll be like, oh, I buy. It's like,
Yeah.
you need a little bit more than just, oh, look, number go up, I buy, or number go down, I sell. Like it needs to be.
Well,
you need to-
institutions loves retail that's like that, because they
They
make
really
price
do.
go up so that people buy. And then when they see that, that the volumes are, dropping off or whatever, then they sell all theirs, dump the price. And then, once they see everybody panicking and, selling, and it gets to a point where it's starting to bog down again, then they buy back in. And I mean, you can see it on the heat maps, on the, the trading heat maps that people use, where it shows the people using leverage. It shows, like, I can show it here after this.
Oh,
But
yeah.
it shows where the liquidity is stacked up with people doing longs and shorts. And you can watch it ping pong, just liquidating people all day long. But
Well, yeah, because if you're an institution and you're making markets, well, you probably have enough capital to be able to move those markets. And so if we're talking about crypto markets, they can be very thin. And so here, another piece of terminology. What does thin mean? Well, it means not much liquidity. And so if a market is thin and a big order comes in, or a market maker wants to push the price up or down, well, if it's thin, they can do that with very little capital. And so these big market makers, these big institutions, they absolutely can and do push prices up or down. And they do so because of what Myke was talking about. You can see where there is liquidation levels, where they exist. And you can see the liquidity that exists at different liquidation levels. And so market makers will simply, they call it stop hunting. They'll just push price up, grab the liquidity, and then price pulls back down. They'll grab the liquidity down below, and it's just a ping pong, just like you were saying. So, if we bring it on over here to this, though, it's one thing to say that position sizing is 80% psychology and 20% math. It's one thing to say that. But what does it actually mean in practice? Well, what it means in practice is, in order to learn about your own psychology, you really have to, you've got to get out there and you've got to trade a little bit, but you've got to trade small. And you've got to listen to your body and listen to your mind, because a lot of the psychology stuff will actually show up in your physical body. Here's an example. If you get into a trade and maybe the position size is too big, your body's going to tell you if it's too big, and you'll start to maybe get sweaty palms, or your heart will flutter. I swear, man, this is a real thing. Your body can react to this. And maybe you get a little bit of anxiety. Maybe your palms sweat. Some people will start to get a little bit nauseous sometimes. Maybe you find yourself compulsively checking the quotes to see, did it go up? Did it go down? Maybe you find yourself compulsively thinking about the position or the asset that you're trading. Maybe you can't sleep at night. Any of those things happen to you, your position is too big, or you're using too much leverage. So you can't really learn that stuff about yourself until you get in the game. So there is such a thing as market tuition. Everyone at some point pays tuition to the market. What you have to make sure that you do is make that tuition worth it. And the way you make it work, yeah.
Well, there's a lot of influencers out there that talk about this. What's his name? Jason Casper, and a bunch of the the big traders, Crypto Face, and all of them, Drew over at Blockchain Basement. They all talk about that tuition. Basically mistakes. Kelly, Kelly Kellum over at BitLab Academy. They talk about they paid tuition. They made big mistakes because they let their emotions, get the better of them, and over leveraged, things like that. Didn't do the fundamentals, didn't use stop losses, something that led to them losing a bunch of money. And that's what they call that. Is it was a very hard lesson on making sure that they kept their emotions in check and stayed disciplined, and stuck to the fundamentals of making sure they have stop losses, and mitigating their risk using delta neutral positions, and all these different things. So
Yeah, so it's only a lesson if you actually learn something from it.
that's
Like,
the key.
like if you just keep repeating the same mistake over and over and over again, well, eventually you'll pay all of your capital to the market and it'll be tuition, but you will have gained nothing from it.
Well,
So,
what's even better than making a mistake and learning from it is learning from somebody else's mistake.
yes, because then you don't have to make it yourself.
Exactly.
That's such a good point, man. And something that has really worked well for me is just keeping a journal, like writing everything down. I'm just showing my journal here.
Diary. I lost $100,000 today.
I mean, look, if you've ever experienced a trading loss like that,
Yeah.
for me, I've experienced losses like that. I've also had plenty of gains like that too.
Mm.
It's the weird thing for me is the losses, I didn't feel anything. Instead, it was like I was cold and I just wrote it all down. But yeah, no, that's no fun, man. But those are some of the most valuable experiences though, because you learn real quick exactly what not to do. Whatever the mistake was that you made, you learn not to do it. And I guarantee you'll never repeat that mistake ever again. So let's go ahead and play through this.
So, why is this psychology stuff so hard?
Okay, so the investor mindset course, Myke, is actually based on 12 books. So I took different chapters from 12 books and compiled them together using AI into the investor mindset course. And so this is from a gentleman named Daniel Kahneman. I believe he's a Nobel laureate, and he wrote a book, I think it's called Thinking Fast and Slow, about these two different systems in your brain. What was that?
I said he sounds conflicted, thinking fast and slow.
Yeah, well, because we're all conflicted. We have these two different systems in our brains that react completely differently. And when we start to take risk, either as as we start to take risk, either as traders or investors, and something goes wrong or something goes right, this fast system one starts to take over, and it tells us all this emotional crap. And the emotional stuff, it always leads to poor decision making. The only way that you can be consistently profitable is if you focus on using the slow analytical system two to build a plan, write it all down, and then in a disciplined way, stick to your plan and do not deviate ever. Because
if you feel yourself getting emotional, standing up and walking away for a minute, go do a workout, go for a run, go do some work, out on your property or something like that. That's what I do.
Yes.
I mean, none of us are immune to what David's talking about.
No.
It happens to the best of us. So, you need, and the worst of us, but but sometimes you just need to walk away for a minute. Same thing as you're having a conversation with your significant other and you feel, emotions starting to well up and you're going to say something that you're going to regret. Walk away for a minute. There's nothing wrong with it. Hey, I need a minute. walk away, calm down, and then come back, when you clear your head. But go ahead.
Yeah, so standing up, working out, walking outside, touching grass, taking pen to paper and writing down what's going on.
Touch grass or touch some ass, either one.
There you go, man. So let's see what the video content has to say about this.
All right.
Well, it's because your brain is literally at war with itself. You've got what Nobel laureate Daniel Kahneman calls System 1. That's your fast gut reaction brain that runs on fear and greed. And then you have System 2, your slow, analytical brain that actually calculates risk. The problem? When the market goes wild, that emotional System 1 completely hijacks the control panel, leading to disastrous moves like panic selling at the bottom or FOMO buying at the top.
How many of us have experienced that, where markets start moving against you and or in your favor? And you start thinking, let's say markets moving in your favor. You start thinking, oh man, I'm going to take off my take profit level, or I'm going to set it much, much, much higher or much, much, much lower because I know something. And look at all this money I'm making. I'm so smart. And yeah, I'm just gonna make $1 million.
That ego sneaking in there.
Yeah, man, that will lead to ruination.
Yeah.
But what you need to do instead is stick to your plan. Like, that's what you need to do. So this System 1, man, it will literally hijack you by using your emotions.
And that leads us directly to the heart of the matter. The real fight here is internal. It's you versus you. It's not about being smarter than the market. It's about being smarter than that emotional, impulsive version of yourself. The whole key is to create your rules of engagement while your calm, analytical brain is still in charge.
Right.
Look, here's the bottom line. We're not trying to be fortune tellers here. That's a loser's game. We're trying to be professional risk managers. This whole framework is designed to give you a system to control your own behavior when things get chaotic, so you can move from making emotional reactions to executing a professional plan.
Right.
Okay, so let's get specific. Before we can build the right solution, we have to diagnose the problem. And the research shows there are really 3 main types of risk that are probably hurting your portfolio right now. First up, we have the most dangerous one of all, ruin risk.
Okay, so this is really important to understand before you even get in.
Investing with money that you can't afford to be investing with.
Yeah, like if you're trying to start learning how to trade with your rent money, that's probably not a good idea.
Bad idea.
Like if you've got a wife and kids and you're trading with the mortgage money each month, don't do that. That's called, you're setting yourself up for ruin. And, it can be catastrophic where you can't recover or can't recover in a reasonable amount of time. So one of the most important things is making sure that you survive to fight another day. Like you've got to be able to, get back in the driver's seat and trade again tomorrow, even if you lose today. And there's no way you'll be able to do that if, number one, you're trading with money that you really can't afford to lose. And number two, you just size everything much, much too big, or use much too much leverage. Or maybe you just trade like shit coins for some reason. So yeah, let's play through this, man. This is great stuff.
This is the absolute account killer. We're not just talking about losing money. We're talking about losing so much that you get knocked out of the game for good. It wipes you out, not just financially, but psychologically.
So you can get wiped out psychologically without losing your shirt. That's the thing. If you have a series of losing trades in a row and you didn't write down your plan and expect that, hey, you know what? At some point, I will have 5 losing trades in a row or something like that. You should expect that to happen because that's part of this game. No one wins every single time.
All the best traders always say they win more than they lose. You're going to lose, sometimes. Absolutely.
Yeah. And you have to prepare for that psychologically.
Mhm.
so that you don't deplete your emotional capital.
Psychologically prepare for a kick in the nuts.
That's basically it. But not just one kick in the nuts. You got to
Yes.
get prepared to
Multiple
get kicked in the
heated
nuts
kick in the nuts.
5 times in a row.
A line of people are preparing to kick you in the nuts.
That's exactly right. But you got to be prepared to have 5 dudes kick you in the nuts 5 days in a row. And then on the 6th day, you got to show up again and get
Yep.
ready to get kicked in the nuts. But that 6th day, you won't. On that 6th day, you'll soar, man. You'll have a great trade and
Mhm.
you'll follow your plan. But you got to be ready to get kicked in the nuts, though.
But again, keep those emotions in check, because if you're beat down, then all of a sudden you're getting a win, and you start thinking, oh, I need to make back what I lost over those
Oh,
5.
don't do that.
Don't do
Yeah.
that. Don't chase.
No. That's
Stick
they,
with
they
paper
call
trail.
that revenge trading.
Yes.
And that's one of the biggest pitfalls that beginners fall into, because you have a couple of losers in a row, and then if you start to size things up even more, or use even more leverage,
Yep.
or trade something even more speculative to
Mhm.
try to get back to even, that is a great recipe to go to zero. Don't do that.
Ending a trading
Oh, whoops. Let me open this back up here. There we go. Let's hit play.
career before it even gets started. So let's do a quick gut check. I want you to be brutally honest with yourself. If your biggest position right now went to zero tomorrow, would you be devastated?
So ask yourself that question. If your biggest position went to zero overnight, would that take you out of the game? Would you face ruin if your biggest position went to zero overnight? Well, if the answer is yes, for anyone who's watching or listening, if the answer to that question is yes, your position size is too big. Period. Full stop. And you must take action to reduce that position size, because you just can't afford to not be able to trade another day. You've got to be able to stay in the game. So
If your immediate calm answer isn't, yeah, I'd be fine, then your position is just too big. Period. Next up is the silent killer, emotional risk. This is when a position gets so big it literally poisons your thinking. Fear and greed completely take over, and all your rational analysis goes right out the window. Your portfolio stops being a tool for building wealth and becomes this emotional prison.
So have you ever experienced that, Mike, where you're in a trade, or maybe you've got a couple of positions on, and you're just kind of bouncing from fear to greed based on what the market is doing? I've experienced that a couple of times. Yeah.
I don't trade much, but I have before, and I definitely understand what this is talking about. Just as you're watching it, go up and down, you see your entry, you see your stop loss, you see your take profits, whatever, and you're seeing that moving up and down. That you catch yourself either getting greedy and, like you said, moving your take profit up, things like that, or for me, something that I would do is to kind of check myself is my stop loss. As if I was in a long, as the price was going up, I'd continually move my stop loss up so that it was like a percentage below, what the current price was. So no matter what, I'm locking in profits, because if it dumps all of a sudden, yeah, I didn't catch the top, but I'm going to leave with more money than I entered with. So that's kind of one of the ways that I checked myself.
So what Mike is talking about there, it's called rolling down your stop, or rolling up your stop. And so by doing that, you can actually ensure that you lock in profits no matter what. So once your position shows you a profit, you can roll up or roll down your stop, just to make sure that you always have a profit on that trade.
And roll up is for longs, and roll down is for shorts.
Right. Exactly. Yep. So if I'm taking a look here at this little slide here, if you've ever experienced this, where depending on what the market does, you either experience greed, thinking, oh man, this is great, I'm going to make so much, or fear, thinking, oh man, what happens if I get stopped out? How much am I going to lose? If you're just bouncing from fear to greed like that, then you're really just running on that fast system one, that emotional system one that does not make good decisions. And also, your position sizes are probably much too big. So, the goal of knowing this stuff is for you to be able to read your body and read your mind. Because when your mind is bouncing from fear to greed and your body might be reacting in some way, you know your position is too big. So all you've got to do is start cutting the position size until you no longer fear or
When it's too big, you need to change positions.
yeah. Oh, man,
Emotional prison. So how do you know if you're a victim of this? Well, here's a dead giveaway. How often are you checking your phone, looking at your portfolio?
Right.
The more you check, the more emotionally compromised you are. A great rule of thumb from the research is if you find yourself checking a position more than 3 times a day, it's way too big for your mental well-being.
So did you hear that? More than 3 times per day, and the position is too big. It's not like, oh, I just kind of check my phone, 10 times a day looking at quotes. If you're doing that and you're doing that compulsively without even thinking about it, well, you're probably trading too big. So, you know, if you weren't trading too big, you wouldn't have that emotional pull to check the quotes all the time.
And finally, you've got the flip side of the coin, opportunity risk. This is the trap of betting so small that, look, even when you're right, it barely moves the needle. And that just leads to frustration, right? It causes you to overtrade and eventually take on some crazy risks out of sheer desperation to see some real returns.
This is a really important point because we can talk until the cows come home about not trading too big and not using too much leverage. But you can also make the opposite mistake by trading much too small so that when you're right, you don't make anything. It doesn't matter, like it doesn't actually move the needle. So this is really important, not trading too small and also not trading too large. And so how do you know what's too big or what's too small? Well, based on your psychology, the way that your body reacts, the way that your mind reacts, but you also know based on math. And that's where we get to the 20% part. So if it's 80% psychology, what's the 20% math? We're going to get to that in a second.
Okay, enough with the problems. We've diagnosed the 3 ways that risk can absolutely wreck you. Now, let's build the solution. Let's talk about the professional framework for sizing your positions based on logic and conviction, not on gut feelings and emotion. This table right here, this is the heart of the whole system. Think of it as your new rulebook. It's simple. You score your conviction in an idea on a scale of 1 to 10, and that score gives you a hard, non-negotiable cap on how much money you can put in. A proven, battle-tested 10 out of 10 idea? Great, 5% max. A more speculative bet? You're capped at 1%. And if your conviction is less than a 5, you don't put a single dollar in. No edge, no trade.
That's so important. It's okay to not take a position. You don't always have to be trading something just for the sake of trading. So remember, cash is a position too. So having no position is actually a position.
Inflation is just a losing one.
Yeah, unfortunately it is. But it's still a position though.
It is.
And
It is.
Cash is like a zero strike option. It really gives you the optionality to take advantage of an opportunity when it arises. Let's say
Well,
that there's
really quick, and a great way to combat that is you can be in stable coins and use DeFi, like lending and things like that to mitigate that 7 to 10% inflation that we've been dealing with. So you might not, I mean, there is opportunities to make more than that, but even if you get into a position to where you're only making 7 to 10%, that negates that inflation. So stables is a great place to do both, both combat inflation and do what David's talking about. Just have that liquidity on the side so that there's, whenever you do see an opportunity, when you do see a trade, when you do see a DeFi opportunity, you have the liquidity to jump into that.
Exactly. And you don't have to be afraid of being in cash. In fact, if you're comfortable operating in DeFi and you head on over to a protocol called Pendle, you can actually enter what are essentially like DeFi bonds. They're basically bonds. And you could right now today build a portfolio of DeFi bonds earning between 10 and 15% on cash, on stables. You can do that without taking on any leverage at all. So there's some pretty great opportunities over there on Pendle.
Absolutely.
But take a look at this though. This is really important, I think. So if you're going to build a DeFi yield farming portfolio, then you should probably listen to this, where if you've got a proven battle-tested protocol and your thesis is proven and battle-tested, look at what the maximum position size is, 5%. This is not 50%. This is not 100%. Like if you've got a great idea and it's based on a proven battle-tested thesis and you're very high, you've got a high conviction score here, like you've got a very high level of conviction that you're right, even when all those things line up, it's still max 5%. Because what happens if you're wrong? Or, God forbid, something horrible happens, like there's a protocol exploit or a hack, something like that, and your position goes to zero overnight. Well, if you had 5% in that protocol, you survive. You don't face ruin from one position blowing up on you. But if you would put 50% of your portfolio in that one high conviction, proven thesis position, and it goes to zero overnight, man, now you've got to double up just to break even. That's very difficult to do. So,
and again, an emotional one and a dangerous one, because like we were just talking about, with that revenge trading, that's kind of revenge DeFi, where I lost that, so now I need to double up so I can make that back, and then if you lose that one, now I got to double up again. I got to double up again. Next thing you know, you're just in such a deep hole that you're looking up and there's no way out.
Yeah, you got to just make sure that you follow a system. When you have losses too, you've got to follow the system. And sometimes that system tells you to take a break and just pause for maybe a couple of weeks and then come back to it with a fresh and clear mind.
And before you pull the trigger on any trade, you have to run it through these 3 simple psychological checks. The biggest one, the one that never lies, is the sleep test. If you're lying awake at night thinking about a position, it's too big. It's that simple. If a trade fails any of these tests, you have to reduce the size immediately, no questions asked.
So take a look at this. This is just so important. How many times, for anyone listening or watching to this, how many times have you experienced this where you're laying up at night thinking or worried about your position, maybe, or feeling a feeling of greed around your position, thinking, oh man, I can't wait until I wake up tomorrow and I'm going to see how much I've made, or man, I don't know if I can even fall asleep tonight because I'm so afraid that I'm going to lose it. That sleep test, if it's keeping you up nights, it's too big. Period.
And that's something I have no issue with. I'm so dead inside. I mean, pretty much my only experience in crypto so far has been the bear market. So I'm so dead inside that, I haven't cashed out, in anything into fiat, or, I've just reinvested everything. So to me, it's just a number on a screen in my mind. There's like no actual value there. And that's kind of how I keep my mindset, so that I don't allow myself to get emotional.
Yeah, man. Well, if only we could all be dead inside.
All right, now let's build that safety net. These are the rules you create before the emotional storm hits. This is what's going to protect the rational you from the irrational you when things get crazy. The idea here is to literally make a contract with yourself for every single position you take. It forces you, while you are calm and logical, to define everything up front.
So this is so important. And you can do this literally in a couple of minutes. And I think it's best to do it using pen and paper. Literally take pen to paper and write all this stuff down. Write down where you want to enter the trade. Write down what the position size is in US dollar terms and what percentage of your portfolio that position is. Write down your stop. Write down your take profit level. And you got to make sure that you don't just write it down, but that you actually stick to it. Like, you can write this stuff down all you want.
It would be good if you write it down and you follow it.
You got to actually follow it, man.
Entry, your size, and most importantly, your exit points, both for taking a profit and for cutting a loss. You write it down, you commit to it, and you don't deviate. Now, the absolute bedrock of this whole contract is the 2% rule. It's so simple, but it is incredibly powerful. By never risking more than 2% of your total account on any single idea, you guarantee your survival. Think about it. You could be dead wrong 10 times in a row, and you'd still have 80% of your capital left to keep fighting.
So it doesn't necessarily need to be as small as 2%. I think this is most valuable just so you can think about the math. Because if you risk 2% of your portfolio on every trade and you're wrong 10 times in a row, 10 losing trades in a row, that would be a pretty horrible streak, but it happens. So let's say that you're wrong 10 times in a row. Well, you're down 20%. You're not down 80%. You're not down 90%. You didn't lose everything. You're down 20%. And guess what? You can recover from down 20%, but you really can't recover from down 90 or obviously from down 100%. So, yeah.
And this isn't just for single trades. You have to pre-program your response for when your whole portfolio takes a hit. When your account hits these drawdown levels, these actions are automatic. There's no hoping, there's no debating. Your portfolio is down 20%, you cut everything in half. Down 35%, you go to cash and you take a break. It takes the panic right out of the equation.
So if anyone has ever experienced losses like this, especially a really big loss like minus 35% or greater, I think that it's really important to just pause, go to cash and pause, take a break, maybe for a couple of weeks, maybe go on vacation or like get out of wherever you were, just you've got to be able to reflect and you can't try to revenge trade, so down.
Personally, I just grab a beer. I go down to the creek. I go sit in the creek with a beer and just like watch the deer and the birds and stuff. It's just like
perfect. Yeah. That's exactly what you should do. Like if that's what works for you, perfect. Maybe for someone else, it'll be, whatever it is, go for a drive. It doesn't matter. Just whatever you do, you've got to get away from the screens. You've got to just take a break when you experience a loss like this.
Okay, let's bring this all home with what is honestly the single most powerful mental shift you can make as a trader. This one idea can reframe your entire goal in the market. This slide says it all. The amateur, the gambler, they think in certainties. This is a sure thing. I'm betting the farm. The professional thinks in probabilities. This looks like it has a good chance of working out, so I will risk an appropriate amount of my capital to find out.
Did you hear that last part? I will risk an appropriate amount of my capital to find out. It's about how much am I willing to risk to find out if I'm right? And how many times am I willing to make that same bet to find out if I'm right?
100% all in.
That's what this guy does, man. Look at him. He doesn't look like he's calm and unemotional. He looks like he's freaking out, just going all in because it's a sure thing, don't you know? There's no such thing as a sure thing.
No.
The only thing that you can do is be calm and rational and deliberate with your planning. And you've got to expect that sometimes you're going to be wrong. But
Well,
you've got to think about that
want to
going
watch.
in.
You want to watch this psychology in real time. Is if you're ever in Vegas or in a casino, like don't gamble, just watch people. and watch the gamblers that are making money. They're calm, they're collected, they're calculated. It's the ones that are, like hunched over the table, and, they got their drink and they look disheveled, like they haven't slept in days. And, they got a couple of chips in front of them and they're, fidgeting. And, those are the people that are, the first one there, they thought that they had it figured out, and they, bet money they couldn't afford to lose. And, now they're at their wits end. Whereas, the person that's calculated, that has, a bunch of chips in front of them, is because they have a system. They have, they kept their emotions in check. As they were winning, they didn't start betting more. Maybe they started betting less. They did the opposite of what the emotional people do. But go ahead.
It's so important. It's so important, man. And if you ever go to a casino, I love casinos. I love gambling, man.
See the difference? It's a total shift from raw emotion to a disciplined process. And that leaves us with the ultimate takeaway. This is the question you need to burn into your brain. Stop asking yourself, will this go up? And start asking, how much am I willing to risk to find out? The moment you make that shift, you stop being a gambler who bets on outcomes, and you become a professional who manages risk. And that, my friends, is the only way to survive and truly thrive in this game.
That was so good. So instead of saying to yourself, will this go up? Instead, you say, how much am I willing to risk to find out? That's the core of it right there. So, Myke, I think we've run out of time, yeah?
Absolutely.
No, man, that was great.
I need to go. I need to get ready for that interview. So those of you that maybe don't know, myself and Drew over Blockchain Basement, here in about 45 minutes, we're going to be interviewing Shal Kafur. I hope I pronounced that right. He is the co-founder, and at one point was the COO, and the CTO of Digital Asset, which is the company that created the Canton Network. He has a huge background when it comes to. He was part of Zcash and ZK Snarks and things like that. A huge resume, and we'll go over all that on the interview. But if you're interested in Canton Network, it is a huge RWA DeFi play that me and Drew found pretty early on and got involved in, and the people in our community have actually been using a DeFi play to stack Canton. So again, all that we'll talk about. If you haven't already, in the description below on YouTube and on our other channels, there is a link to David's DeFi University. On our YouTube channel, there is a link to his YouTube channel. Make sure that you throw him a follow. And we're going to be here every day giving this, very basic, very simple, easy to understand DeFi content. So, make sure that you join us 9 a.m. Pacific, and what's that, noon Eastern time. Any closing thoughts, David?
Yeah, so when I think about markets, I think it's really mostly about learning this thing, learning your brain, learning yourself. So the only way to learn about yourself and how you handle risk is by taking risk. But when you pay market tuition, when you're wrong, make sure that you learn something from it and you don't repeat those mistakes again. The way you do that is
for your money. Make sure you get
pen and paper, man. Yeah. Take a pen to paper. That's what I got for you.
I do want to, and my closing thought is, one thing that I want to put out there is, if you haven't already, there is a great new social media platform, not new, it's been around for a while, but it's growing, called The Arena. It is a place where there's still a lot of, there's freedom of speech. We started streaming over there a couple of weeks ago. Great platform. And it's a blockchain. It's a Web3 platform built on Avalanche. So if you haven't, make your way over there, create an account. We're going to have a lot of great content that is exclusive to that platform. So until next time, Veteran Crypto out.
Peace.